In this next video, I want to talk to you about two different counterpunch approaches. Both are very good, and I'm going to illustrate this to you by using the Aussie US 15-minute chart, although these approaches can be used with just about any market. You'll notice I have my two exponential moving averages. I'm going to put on a third average. This is a simple moving average. This one is not exponential, set to 20. Okay, this is a very useful indicator. All right, so let's look at a few trades here. With this particular trade plan, you can trade the Asian session, the European session, or the US session. I've changed the targets. Let's look at the calculator. And I've set target 1 to 1.5, target 2 to 2, and target 3 to 2.5. With day trading Forex, I like to go with the bigger targets because you have to account for the spread. Okay? You always add the spread to the buy side of the trade. Also, instead of 2 bars closing on the opposite side of the jump line to cancel a trade, I set this to 3 bars. Okay? 1 extra bar. That means 3 bars have to close on the opposite side of the jump line to cancel a trade. Alright, so let me show you the basic approach first. The basic approach, we don't need the 20 simple moving average. Let's just say we're going into the Asian session. The Asian session is right at the start of the new day. This is happening down in Australia and New Zealand. You want to wait until the spreads get normal, right? The markets have been open for a while and the spreads have come back to normal, and then you could start taking trades, and you want to just trade to the first winner and then you're done. Power of quitting 1. All right, and we're in a chop zone, but the trade is above the 50 EMA, and so when it comes up and triggers in right there, you can take that trade. Right, there's your setup, there's the bar that triggers in, actually that one. Okay, and you're going to go to one of these 3 targets, and it comes up and it hits target 1, target 2, and target 3, and you're basically done with the session other than trailing. So you trail the remainder of your position up to here, and it's going to stop out right in this area. Okay, I have the trade tracking off. We're just doing this manually. The calculator would have been tracking the purple trade. Okay, but our first trade could have been the purple. Could we have gotten in sync with the purple trade? We could have, and it would have worked great. Either way, you can get in sync, you can not get in sync. In this particular case, we're taking that fresh setup right there. Okay? So that's the standard approach. The standard approach is that you just take your trades as they come. So now let's say you're trading the European session, which starts at 2 a.m. Okay? And you have a setup right there. Triggers in. Goes to target 1. You're moving your stop up, locking in. You're trailing the jump line. Goes to target 2. Just barely misses target 3. If it misses by such a tiny amount, you know, a pip or 2 or whatever, I'm going to be aggressive with that final third position. Maybe I move my stop to the middle target, or maybe I just mark it out with one of my positions and then trail the remainder. All right? Again, the standard approach. Now we go into the U.S. session. The U.S. session, say, starting at 8:30. That's typically when I'm looking at the U.S. session. You have to work around news, of course, but you have a counterpunch trade, and it triggers in. Notice that you're going against the direction of what looks like a pretty strong trend. It ultimately works its way down, crashes through, hits target 1, and then comes up, doesn't quite hit target 2, comes up and stops out for a small gain on the remainder of the position. And that trade's done. So the Asian session, the European session, the US session, all 3 sessions, 1 trade, 1 winner, 1 and done. We love it. And that's how we trade the standard approach. Sometimes you're going to get stop and reversals. And if you get a stop and reversal, you have to be very careful. You don't want to ignore it. You don't want to be afraid of it. But you always want to ask for extra confirmation on a stop and reversal. And I'll show you some examples, okay? And when you're using the first approach, which is everything I've taught you up until this point, then you usually with a stop and reverse, you're going to want extra confirmation. So here's an idea. Here's an example. Let's say we got long here. Okay? That's before the start time of the plan. But let's just say we got long here and we have a stop and reversal right here. Now, in order to take a stop and reversal, one of the things I want to see is I want to see confirmation that we've got the histogram, the signal line is flipped from above to below. Okay? The other thing I would want to do is add a couple pips. So instead of getting short right on the entry, I might go a few pips lower. Okay? And if I'm right near the stop anyway, I might just put it right at the stop. In this case, it's obviously going to stop and reverse. Okay? Sometimes you might save the trade and it will go up the other direction. So asking for additional confirmation is really smart. Of course, we are in a chop zone and you'd be trading down against the direction of the 50 EMA, and that's not advised. This is a case where it actually works pretty well. The chop is happening way up here above the 50 EMA. One of the things we learned in Trend Jumper is when the price extends above the EMA further than the distance between the 200 and the 50 EMA, that the price is going to want to get back down to the 50. Okay? So maybe you have an exception to the rule in that case. Again, these are things you're going to learn as you continue to trade this strategy. And we'll talk more about that as we look at specific examples in the rest of this training. All right? But if you just follow the dots, you could take the EMAs off. You don't even ever have to use the EMAs. Remember, the EMAs are optional. Now, here's the second approach. I call this the trend approach. I really like this approach, and I think you're going to like it too. It simplifies things a lot. You put on the 20 simple EMA, and with this approach, you only take trades that are in the direction of the EMA. Notice that when we put on that EMA, we could see a real strong trend here. We can see all three lines trending and accelerating away from one another. All right? So you're probably not going to want to take shorts that are at or around this blue line. You want to wait for the actual indicator to turn down, and then you could take the short trade. When you take the long trade, like the one that we pointed out here at 2 a.m., this one, on the European session, the simple EMA is up, you could take the trade. What you're not going to do is take the short trade here because you're going against the direction of the EMA. What about this one? Well, look what happens. If you look at the bar before, the reading is at 77884. If you look at the bar before, the reading is at 77885. Then we get our setup bar, and the reading has gone down, 77884. So that means that it's moved lower, so you can't take that trade. But then it starts to move up, and when it moves up, now you can take the trade, and it triggers in, and obviously it zooms to target. If you were taking the purple trade, obviously you can see it was down and then it went up. But once you decide to get in sync with it, you want to make sure it's going up before you get in sync. So the whole idea with using the 20 simple EMA is you take trades that agree with the direction of the EMA. And that's going to save you from some bad stop and reversals sometimes. So when you get to this US session, it changes everything. First of all, you can't short it because the 20 SMA is up. Okay? But look what happens. Notice that on this bar, it's at 78377. And on the next bar, it's at 78377. So it didn't go down. And then it went up again. So you would still be waiting. And there's a chance it's going to push through and come down, and you're going to miss that trade. That could happen, and it will happen with this approach. That's okay. You just wait for the next one. In this case, you can get in sync because it does start to turn down. Let's see if it does. Actually, Here's a case where it turns down here, but it's already pushed through the entry. And so then you have to decide, well, it's only a few ticks. Can I take the trade? One tick below that bar. You're going to have to decide if that's okay or not. Okay, because you're only, it's, you know, do you give up a few ticks for the extra confirmation? I think it's acceptable that you do that. When I'm back testing this, I did not count that trade because I was only looking for exactly when the moving average was down and then take the short. All right, so what about this though? You see how you avoid the long trade here because it's coming down? And that one almost hit the first target, and then it comes up and hits the first target. So that ends up being a winning trade that you also miss. You're going to miss winning trades, but you're going to have a very high winning percentage on the trades you do take. There's always a trade-off when you're using filters. Let's look at this example with this approach. One thing with the three moving averages, the two exponentials and the one simple, is you could really see where momentum is when you see the fanning out and the spreading away. So when you get a counterpunch set up here, how interested are you in that trade? Now, if you didn't have the moving averages on here, it would look a lot different, and you might take that trade. But because with this approach, you only trade with the trend of the 20 simple average, you avoid that long trade. And instead, now you're looking to go short. This one, remember, has to go 3 above because of how we set the calculator. That one cancels. You have 1, 2, 3 closes above. Okay, but then you get a long setup. Well, you can't take that because the indicator's still down. So it saves you another would-be losing trade. And instead, now you have it moving down. You have a short setup. And that's where you get your nice winning trade. Almost hitting that second target. Now we're coming into the European session, but because the SMA is down, you can't not take the long trade. And look, it saves you another losing trade, you see? And instead, you have a short trade. And that's a nice trade. It actually is very large, so you're going to want to manage this for profit. With this trade plan, if you've gone over 20 pips, you're going to start trailing the jump line. And ultimately, you're going to stop out right down here for a nice winning trade. Now we're getting into the US session. We can't go long here because it's against the direction of the SMA, and instead you go short. And that one comes down, and it hits its first target, which is good for 18 pips minus spread. And then it's going to stop out for break even on the rest of the position. So you get a winning trade on the Asian session, a winning trade on the European session, and a winning trade on the US session using this simple idea of only trading in the direction of the 20 simple moving average. We have a trade plan for the Dow E-mini that allows you to trade up to 5 trades in a session, and that's it. And you could trade it to target 1, target 2, target 3, or trail. Okay, the trade plan I've been tracking is a 3-position approach that goes to target 1, target 2, and target 3, and it uses the simple moving average as part of the plan. So let's put that on there. So this is going into the most current session yesterday, Friday, February 20th, as per when I'm recording this video. And we're waiting for 8:30. And here it is. And you'll notice that at 8:27 it did stab down, but it went too far. It hit its first target. It went more than 10 ticks. You can't get in sync with that trade. We're not going to chase it. So now we're waiting for a new setup. And we end up getting what would be a long trade, except that the indicator's down. It pushes up on this bar. Now we have to wait for it to come down and touch the entry. And instead, it moves up and it hits its first target, and we miss a winning trade because we're using the trend approach that requires the 20 SMA. So that's a missed opportunity. That happens sometimes. The regular approach, you would have been able to take that trade for some sort of a winning trade, right? Hitting that first target, good for 13 points. Notice that we have what looks like a counterpunch trade. We have a group of dots that's above the two groups to the left. The reason why we don't get a trade set up is because we never got into the blue. The counterpunch trades need to come from the blue. This is still in the red. This is what I would call a special case trade, especially when you're in the chop zone and you're trading down away from the 50, right? You're trading in the direction of the downtrend. You can manually calculate this trade and take that trade. And there's a really easy trick. I use the fib line retracement tool. Now, I didn't count this trade inside of what I tracked. I didn't count it in the trade plan results. However, this is a really good trade and you should learn how to do it. Use the fib line retracement tool and you use your snap tool. Okay, so you can either have it up here on your toolbar or you can go to drawing, snap mode. And you're going to draw from the high of the highest bar, because we're measuring that, to the setup bar, which is that first red bar below the jump line, like so. So it's going to give us a measurement. Now, let me open this up and show you what I did. I turned off all the fib lines and I instead activated other percentage levels, and I put a minus 100%, a minus 150, and a minus 200. That gives me my target 1, target 2, and target 3. You see? And because I drew it from the high of the highest of those three bars to the low of the setup bar, it calculated for me my targets, and I could quickly take that trade. And it was a really nice trade. It's also in the direction of the 20 SMA. So you have a lot of confirmation. Okay? But because it didn't meet the rules of the counterpunch, nor did it meet the rules of the failed swing level, nor did it meet the rules of the second chance failed swing level, we did not get a setup here. It did show us a failure though. Let me move this out of the way for a moment and show you something. It showed us a failure because we got the three dots. So we got market exhaustion. We've got the lines turning down. We're trading out of chop away from the 50 EMA as all the lines are trending lower. There's a really great chance that trade's going to succeed. And so when you learn to master this strategy, you learn how to look for these things. Okay, this is the pure counterpunch before I had a calculator that put dots on the chart. I'd be looking at the situation, assessing it, and taking that trade right there. Okay, but I chose to make the rule for the counterpunch trade that it had to come from the blue histogram first, because then that saves us a lot of choppy back and forth setups that could occur in other situations. So you give up something to get something and vice versa. But when you understand the spirit of the strategy, you can see that trade coming, and now you have a quick and easy way. Program your Fibonacci price retracement lines tool. I'm sure MT4 and NinjaTrader has something similar, and then you can just draw the setup the way I've been teaching you, and you got a great trade. All right, but let's continue going through this particular session. We had a winning trade we couldn't take. We have another winning trade that didn't show up, and so let's say we couldn't take that, and we're still waiting for our first trade of the day. We have a counterpunch long trade, and guess what? We avoid a losing trade because we're following the direction of the 20 SMA. So that's good. Now we have a possible short trade. And the short trade, we have one close above. We have a setup that hits the entry, but we can't take it. Again, it filters out a losing trade. It comes back down, and we get a new setup. So remember, we cancel the old setup, a new setup, we take the new setup, and it is in the direction of the SMA. So it meets our rules, and we can take the trade. Of course, it's come down a long way. It's also extended far off the 50 EMA, and there's a good chance that it's going to want to come back up to it. Remember, it exceeds the distance between the 50 and the 200. So we have to be wary of taking more short trades. Do we want to wait for confirmation? We could, but then we can miss the trade. If we wait for the signal line to cross, this can move much lower and we can miss it. we are deep in the red. Maybe instead we want to just wait for a long trade. Okay? All these are what if scenarios. That's not what this trade plan is. This trade plan says take the trade in the direction of the 20 SMA. And that's the first trade of the day. And it is going to be a losing trade. Because what happens is that if you look at the SMA, it looks like we avoid a long trade here because the SMA has not moved up yet. So you don't take the long trade. You stay short. It comes back down. It looks like we might have a chance of breaking lower. We are in a choppy zone here, but it ultimately moves higher and it's going to stop out. And now we get the SMA long, and we have to take the long trade right there. And that one's going to trigger in, and it's going to give us a nice winner. And then this trade has you trailing the jump line once you hit the first target, so it's going to stop out for a partial. And we still need one more trade to get totally positive for the session. And so notice that this is moving up, so we don't have to worry about a short trade even though it didn't trigger in, and instead we have this long trade, and it's coming in the direction of a steep incline on the 20 SMA. Those are usually good, and that one's going to zoom to target 1 and target 2 and even target 3. It misses by 1 point, and that puts the whole session very positive. So even though there were some missed opportunities because of our 20 SMA rule, because of using the trending approach to the counterpunch, you just have to be patient. The good trades are going to come. Every now and then you're going to get a session that isn't going to work no matter what you do. That's going to happen no matter what approach you use. But by and large, both approaches work really well. I particularly like using the trending approach with my Forex trades, my Forex day trades, and with the Dow Mini. I don't like using the trending approach with the Russell Mini or with crude oil. I think you're better off just trading the standard approach with those two markets. So it really just depends. And in fact, with crude oil, you can go either way. You can trade the normal approach or the trending approach. The normal approach has amazing numbers. It's a strong winning trade plan. The trending approach is going to give you different trades sometimes, but it also is a strong winning trade plan. It's really a matter of preference. The more you use the counterpunch, the better position you're going to be in to determine which style you like best. I want to talk about some other profitable patterns you can look for, and you could even learn to specialize in these patterns. Okay? So one of them is when you have a failed swing level that's right near the counterpunch setup. So if you look at this little cluster right here, you've got a counterpunch here and no setup. Okay, but you might get a setup, but let's just say whether you have one or not doesn't matter. There's another example to your left where you have close failed swing levels. Okay, then you get the failed swing level. So you have the counterpunch, the failed swing level right next to the counterpunch. This setup here, this particular trade setup, whether it be, maybe you're already in the counterpunch and then you see this happen, or you just get this level, failed swing level trade setup, you're going to find that those work really, really well for the most part, okay, when they're right next to each other, and you can just wait for those setups and only take those and make that how you trade the counterpunch and do very well. Obviously, it won't win 100% of the time, but it wins a lot. Okay. Another thing is that you're going to notice sometimes you get setups that are way off the line. Okay, and that isn't always a bad thing. The stop is way up here off the line and the setup bar is below the line. What that ends up meaning is that you have a higher risk trade, right? You have a bigger trade. It doesn't mean it's bad. Look at how this comes all the way down and hits that target perfectly right there. Okay. But you might be someone who wants to just wait for trades that set up at or near the jump line. Those are going to be lower risk trades, and they're going to have a high odds chance of success. So for example, look at how far off these two are. I just told you that's a good trade because it's the level 1 right next to the counterpunch. The swing level barely fails. and then you get the flipping over in the other direction for a really great trade. Okay, but what I'm talking about is a different type of setup. The setup I'm talking about is where you have your setup close to the jump line, your stop and your entry for a smaller trade, and those trades tend to do very well. A couple examples might be this second chance trade. Notice that the setup bar is just barely crossing over the jump line, and we're not that far below the jump line. And we've also got the support of the 50 EMA moving up above the 200. You see? Here's another case where you got the line, the setup bar just crossing over the jump line just a little bit below it. Okay? And so the chances of that trade succeeding are pretty darn good. Another thing is that when you learn, we haven't talked about divergence because I don't really want you to spend too much time with it, but when you're looking for extra confirmation to short against the prevailing trend, you could look and see how as each time the price makes a higher high, our histogram makes a lower high. You see? So that might be a little extra confirmation. The price is extended more than the space between the two EMAs. So now you have two pieces of extra confirmation. Remember, extra confirmation is one of the principles of this approach, and the better you are at using it, the more successful you're going to be, and you begin to learn how to isolate the best trades. You don't want to be too inventive, and you want to give yourself a chance to learn the strategy and get better with it over time. That's just logical. But we'll be seeing a lot of this in the trade room. We'll be discussing it, and we'll be learning and getting better as we go and see this wonderful strategy at work. Again, a perfect trade. I'm trying to find one of those setups that's close to the market. So this one's pretty close, right? You got your stop a little bit above, you got your entry a little bit below. It's a low risk trade. You've also got the EMA just crossing over, indicating a strong continuation to the pattern. Here's another example of a failed swing level that's close to the counterpunch. We don't get a counterpunch setup. We do get the failed swing setup. It looks like a counterpunch trade, but it's not. It's a failed swing level to this one. Okay, but you get the failed swing, one right next to the other. So there's a good chance this is going to go up, and it does. Pretty nice move. Let's take a look at this Russell E-mini example. Yesterday's trading, we're going to start trading at 9:30. There's a setup here at 9:27. It pushes through and it goes too far, too fast. So we just missed that one. Now we have this long counterpunch trade, you see, but there's no setups. There's no targets. On the next bar, there is, but it's already come all the way up to here. Now, do I want to wait for it to pull back and then take it? I could, but one thing I'm worried about is that I'm in the squeeze zone and the 50 EMA is pushing down. So I don't really want to take long trades up against that zone, you see? And it does push down again. That's a trade I'm not interested in. The odds just aren't that good. I want to respect the fact that we're coming down, pushing into the squeeze zone. I don't want to trade against the descending 50 EMA in this case. Okay? And instead, you get a short trade, and that's in the direction of the descending EMA here. This only applies when you're pushing down, when the 50 is pushing down to meet the 200 or pushing up from the other direction. Okay? Plus we got the 200 now starting to turn down. So this is going short from 1223.9. And it comes down, it hits targets perfectly, hits that target, and you could trail the jump line, and you can see now the trailer. Once you turn on the tracking, that's really nice, isn't it? And it comes all the way down to here and stops out. Trading to target 1, target 2, target 3, and trailing was over 11 points. If you're just trading to target 2, it was 27 ticks. If you're trading to target 3, that's 43 ticks. Even target 1 is 17 ticks. That's $170 just to target 1. All the information you need to make a successful trade is right here on the chart. We're trading based on the exhaustion, a failed swing level, and then the breakout in the direction of the trend.